Friends, next up is the keynote address that we are all eager to listen to. Sundaram Mutual Fund CIO, Chief Investment Officer, Ravi Gopalakrishnan is here to address us. A few words about Ravi. Ravi Gopalakrishnan has over 3 decades of experience in asset management. Prior to Sundaram, he has spent time with Principal, Canara Robeco, Pidgin, and many more asset management companies. Ravi has an MBA from Bradley University, USA, and has a very strong bottoms-up approach to investment management and has very many successful stints over these 3 decades in managing investments. With no more ado, over to Ravi.
Good afternoon, everybody. Welcome to the 12th annual summit of the IFA Galaxy. I am Ravi Gopalakrishnan, CIO Equities at Sundaram Mutual. Today, we are actually going to talk about a very interesting topic, which you are all very familiar with: savings and investments and unlocking the true potential in India. As we all know, that the potential is significant. And especially the way the country is poised in terms of the macroeconomic situation, and this generally allows to unleash the true potential of wealth creation in India. So today we're going to kind of talk about some of these topics, in terms of how to capture the wealth creation potential overall. And primarily because, equity being such an underpenetrated asset class in India, we will compare that with a few global examples. And similarly, the changing distribution landscape, especially keeping in mind that, today's session's overall theme is control, alt, delete. How there is a massive transformation in terms of the distribution landscape and how distributors can essentially, upscale themselves or retool or rescale in terms of the changing landscape. And obviously, the evolving role of the mutual fund distributors would be key. So to begin with, let's look at the household savings growth in India. And I'm sure, you have seen these charts many times, but it's good to kind of revisit some of these. We've been growing at a CAGR of about 7.5%. But what is interesting is, you're looking at the overall household savings as a percentage of GDP actually coming down. In a way, it is not something that is, very, very positive, because we used to be saving about 25 to 30% not too long ago, maybe about a decade ago. But now that number has fallen to closer to 20%. Primarily because, the younger generation typically, there is a major push towards consumption, etc., etc. So the overall savings rate has actually come down. But on an absolute term, as we saw in the previous slide, things have been moving quite progressively. If you look at the overall, now this is what makes it very, very interesting, because within the household savings, there are two parts to it. One is the physical savings, which is your gold, perhaps real estate, etc., and the other is the financial savings. So if you look at it in 2012, physical savings used to be almost 70% of the total pie, right? And financial savings used to be about 30-odd%. Today, after about 8 or 9 years, financial savings as a percentage of the overall pie has gone up to 45%. This clearly shows the investors have evolved over a period of time. And, one of the main reasons being, there is a lower expectation of inflation. The new generation typically likes to believe in financial savings rather than, the household physical savings like gold or real estate. Look at real estate. A lot of times it is out of bounds because real estate prices have all gone up quite a bit. Secondly, the rental yields are so low that it becomes very attractive for people to take a home on rent, rather than buying a physical asset. Because even today, if you see, the younger generation are absolutely okay to move around or travel from city to city. So there is no point investing in real estate and buying a home. Maybe later on in their lives, when they are in their 30s or 40s, probably that is a time when they will look at the physical assets. But for now, at least the pie of the physical savings, financial savings, is actually going up. Similarly, let's look at an interesting side of it, which is bank deposits. Now, traditionally, India has been a bank deposit oriented, focused kind of country. And I remember, several years ago, the overall, within the overall financial savings, bank deposits used to be about 80% plus. Today, that number obviously has come down to about 55% of the total financial savings. And there are multiple reasons for that. Obviously, you're getting a lot of other opportunities like mutual funds, and other areas of financial savings, which are probably more tax efficient. From a return point of view, they are working out to be far better. So I think people are understanding the various options today that are available, and the ease of doing investments in the other areas other than bank deposits. So I think this trend will continue. 55%, by the way, is still a very high number. So if one were to look at the overall pie, I think we have a very long way to go in terms of the penetration in terms of the mutual funds. So there is a good case why mutual funds as an asset class should keep increasing its percentage share in the overall financial savings, because it is most tax efficient. Like I said, the ease of doing transactions, etc., plus the role of the distributors in terms of advisory, basically based on the risk return, risk reward framework of the individual investors. So all this has actually culminated into the growth, explosive growth of mutual funds, and which is what my next slide says. I mean, despite having grown so high and so quickly over the last decade, the mutual fund AUM as a percentage of GDP still is very, very low compared to some of the other economies. I mean, if you look at the world average, it is about 75%. India is still hovering around 15% odd. So according to me, over the next 10, 15, 20 years, you're going to see mutual fund penetration actually increase as our GDP keeps going up, as a percentage. Similarly, if you look at the market cap, overall market cap, also, I think the equity penetration is extremely low compared to our global peers. I mean, India is close to about 6% if you look at the total mutual fund AUM vis-a-vis the overall market cap. This is equity AUM I'm talking about. That number can obviously move up dramatically over the next 15, 20 years as the habit of equity investments keep improving or keep increasing. We all know this number, the way mutual fund assets have grown over time, total AUM of about 38 lakh crores. These are January numbers. And especially in the last 2 years, I think, things have dramatically changed. If you look at, even the various split between equity, debt, liquid, and others, equity obviously has got a much higher share than debt and other liquid investments. But the rate of growth is also going up, primarily because of the overall global view, not necessarily the India view, that India is come of age in terms of the macroeconomic situation, perhaps will be the fastest growing economy over the next 5-10 years, thanks to the various steps that this government has taken, post-COVID. It has put India on a different pedestal altogether. So I have no doubt in my mind that this number will, keep on improving as we move along. I'm sure you're familiar with this chart, but it doesn't hurt to remind us, how equity investment is actually rewarding. So this is something, a 1 lakh rupee invested in 1979 is closer to 4.6 crores, right? And this is, by the way, index. We are not even talking about any alpha generation by any mutual fund or something like that. Blindly, if you put 1 lakh of rupees in the index, if you had put in 1979, it would be worth about 4.6 crores. Now just imagine, the importance of staying invested, right? I mean, all of us keep talking about the fact that you can't time the market, you can't go in and out. This war situation, many people have started asking me, should we take some money off the table? Now just imagine, if you've missed the best 10 days in the market, your return from 4.6 crores would have gone to 1.6 crores. Would you want to take that chance at all? So it is important not only to take a longer term view, but it is important to stay the course, stay invested all through, despite the ups and downs. Now, last 10-15 years, we have seen so many events happening. We had global financial crisis. We had a major restructuring of the Indian economy, GST, and all of that. Plus the COVID, which was like, a situation where everyone thought that we'll all be dead. Fortunately, things have improved a lot from there, and look at where the market is. Now, again, we are threatened by a new development in the Russia-Ukraine standoff. And perhaps, this could be another opportunity for investors. Now, in line with that, let us kind of look at, the extent of the demat account growth. There's been a dramatic shift in terms of people opening new demat accounts, in the last 2 years. Post COVID, there has been a dramatic growth in terms of the demat accounts. If you look at those numbers, in 2018-19, it has gone from like 359 lakh accounts to 738 accounts. So literally doubled in 2 years' time. And if you look at the monthly demat addition, it is 7x the monthly average pre-COVID and what it is today. So, this shows the equity culture is actually just beginning to get into an explosive growth territory. And that is, that should sound as music to everybody involved, the mutual funds, the distribution community, the investors, everybody. But there are a lot of things that are happening underground, on the surface of it. If you actually see, the entire distributor landscape is actually changing. Just like it is changing for the manufacturer, that is the mutual funds, it is also changing for the distributors. As new players keep entering the financial services distribution framework, offering accessible and convenient services through digital channels, for example, right? We have been offered sophisticated tools to provide customized and low-cost services, right, through the digital channel. And there is a massive potential to transform the entire distribution landscape and revolutionize the traditional way of distribution across various financial products. And there are so many platforms that are available for people, which has made life extremely easy in terms of accessing the financial markets, right? And thanks to the digitization of the banking system also, right? Because everything has culminated and resulted in something where the customer is winning today, because they are able to choose from the various options. Look at the fintech MF distribution numbers. Effectively, it has gone almost 2.5 times to about 27,000 odd crores in 21, from 2020. So it's like, leapfrogging into a different zone altogether. But, certainly, I mean, there is a space for everyone. That is what I'm trying to kind of showcase in terms of this particular slide, whereby, there is a space for the traditional MFDs, because, they play a you guys play an extremely pivotal role in terms of distribution. Whether it is lead generation, customer education, awareness, profiling of the customer, right? What is the client's requirement? Of course, the sales fulfillment, etc., payment collections, post-sale, if there are any issues in terms of performance, grievance handling, etc. And not to mention the cross-selling opportunities, right? Through investor education and all of that, basically, you guys have been pivotal in informing the mutual fund customer in terms of what is the right product in terms of wealth creation, right? And educating them about that. So the technology enablers, on the other hand, are using much more sophisticated kind of tools in order to to be able to be at that cutting edge, whether it is big data or customer analytics, etc., and trying to figure out, what is the best way to service the customer over a period of time. So I think there is space for everyone. But at the same time, I think distributors need to be aware that they can play a very differentiated role in this changing landscape, right? And one of the biggest tools that you can use is asset allocation. Now, why asset allocation is so important? I'm going to spend just a couple of minutes on talking about asset allocation. I'm sure you're all aware of this, but certainly, it plays a very key role in the overall wealth creation, right? We all know from the previous slides, we have seen that we are all underinvested in equities. Indians, as a population, are underinvested in equities. And equity investment, for whatever reason, has become more tactical as opposed to strategic, which means people, whenever the markets are hot, they tend to chase, the markets only when things are good. And when things are bad, people redeem and get out. And there is a need to put more emphasis on goal orientation rather than product specific. There are enough products out there, but what is the customer's goal? So it requires a lot of deep down conversation with the investor to make the investor more sticky, right? And of course, there are gaps in investor risk profiling because the understanding at the customer level is still not to the level that we would wish for, right? So that is because investors have a certain dilemma. Typically investors tend to chase the most hot asset class. I mean, as it would be, right? If equity is doing well, everyone wants to participate, and unfortunately, it is towards the end of the cycle that investors want to participate without really realizing that every asset class goes in cycles, and it is important to understand that. And there are only two important decisions that investors need to make: which is the right asset class based on the risk profiling, and is this the right time? So and these are the questions people ask, right? The timing part one can safely ignore, because if you stay invested, it's about adjusting the asset class through the asset allocation model, whichever you're kind of following. And the importance of asset allocation cannot be undermined because asset classes can be volatile. As I said, asset allocation reduces volatility and gives you a superior risk-adjusted return. And and over a period of time, we have observed that average stock and bond investors have actually underperformed because of their quest for chasing superior returns from time to time. They keep changing their asset allocation based on whichever asset class is doing well because of knee-jerk reactions, etc. So here's a study that was done in 1991, a pretty interesting study that, they put in, 4 criteria in terms of portfolio performance. One being security selection, second is market timing, third are the other factors, and fourth is asset allocation. And interestingly, they figured out that 90% of the time, asset allocation, gives better outcomes, in terms of portfolio performance. So this study was done in 1991. So I thought it was quite interesting to put that on board. And, broadly speaking, investment strategy is actually based on 4 decisions. What is the asset class to be considered? What are the normal weights that needs to be there? You can keep changing the weights based on whatever model is throwing up. Ranges based on the weights, what range you want to be in, and what specific securities should be there in the portfolio, right? So this study basically predicted that 85 to 95% of the overall investment return is based on the first 2 decisions, that is which asset class and what are the weights that you want to align. The rest of the things don't matter over a longer period of time, right? So before I conclude, I would like to say that there is a great potential for equity investments in terms of wealth creation. We expect the mutual fund industry to actually grow at a CAGR of anywhere from 11 to 13%, and equity assets to reach to about 57 lakh crores of AUM in 2026. Now, of course, without the help of mutual fund distributors, I think it's going to be extremely difficult to reach these numbers. While the equity culture is slowly picking up, but the advisory role becomes extremely crucial, and especially with the young generation who are more interested. So there are massive tailwinds that are available as a distribution community for all of you, that the younger generation are willing to look at financial savings much more than real savings, right? Like real estate or gold or whatever. So, that's a massive tailwind that is available. The only gap that is there is the correct advice, and advice on asset allocation, advice on wealth creation, advice on portfolio management, etc., etc. So I think MFDs play a very, very important and crucial role. So, let's all take advantage of the tremendous potential that lies ahead. And, basically, the underlying theme is to stay invested at all periods of time, so we can capture this, the growth potential in the Indian economy and the Indian markets over the next decade or so. Thank you very much. With that, I come to a close. Thanks a lot, and hope to see you in person at some point in time. Thanks. Bye-bye.